Okay, good morning. So before we start just today, we're going to try to go and delve a bit deeper into Ethereum and what goes on on marketplaces where Ethereum is being traded. So just a little background about where the data will come from. So all the data that is being used to derive the insight that will be presented in this presentation come from the public APIs of the exchanges. And what we've been doing at Kaiko since 2014 is building infrastructure to be able to reliably and robustly collect, normalize, store, and then redistribute all this market data. And so the questions we'll be answering in this talk consist of mainly where do people trade, when, at what price, if you want to buy a lot of ETH, how much would you move the markets? Is there any trend, any pattern in terms of when people trade? Do people wake up early in the morning to start trading early? Are there mostly bots trading all day long? We'll delve into this sort of questions. So before I start showing you more plots and charts on exposing this data, I'd like to give you a brief introduction about what this data is. So we'll be looking at basically past year, from January 2019 until about February 2020. And we'll be mostly looking at level 1 and level 2 data from top exchanges and top fiat currencies. So because we're in Paris, I also added a bit of Ethereum Euro, and it will be mostly USD and Tether. So OHLCV data is basically when you look at all the transactions that take place on an exchange, it's usually convenient to group them by time periods or time windows. So you can do this daily, and you will look at what the opening price of the day was, the volume, and the closing time, and at the closing time too, and then all the extremes values and the average price over the day. Order book snapshots are a bit more granular, and it's basically we'll just have a look at what an order book is, but these are called level 2 data. And so what is an order book? So let's say meet Bob and Alice. So Alice has got some ETH, and she would like to sell this ETH, and she just met Bob, and Bob has got some US dollars or euros and would like to buy some ETH. So Alice will give an ask, the price at which she is willing to sell. And Bob will respond with a bid, the price at which he is willing to buy. If these prices are compatible, they will agree on the price, and a transaction will take place. Otherwise, what's going on exchanges is usually you have a lot of those limit orders, which is there's a lot of Bobs, there's a lot of Alices, and each of them have a different price, a different amount they're willing to trade at different levels. So when you stack all those limit orders by price levels, you will see a graph which looks like this. And so as we said, if now somebody places a bid which is closer to the red zone, when it hits the red zone, a transaction will give birth to a transaction which we will be storing. So the difference between the two best offers is called the spread, and the best, on the left side you have the best bid, and on the right side the best ask. So that's the core of the data we'll be having a look at, and this tells you about all the latent orders that are being placed and where people have committed volumes that to the market where transactions will occur if they are met. And all those prices and amounts, of course, change quite rapidly over time. So if you plot them for Bitcoin USD over time of the last month of, I think, the last week of August, you can see, so this is aggregated by various levels, and you will see that there is large changes over time. So what we'll be looking at is basically a snapshot of this data that we'll be integrating to see, for example, now if I want to buy 100 ETH and there is not enough ETH close to the mid price, I will have to go deeper and pay a higher cost to get all the ETH that I wanted, and so by how much I will be moving this mid-price. So these are more details about how we do the calculations and how we define these metrics. So slippage is an important metric. When you're just buying 1 or 2 ETH, you might not be very wary of moving the price. But when you do a lot of trading, obviously, and exchanging larger volumes, you need to nail your execution costs. And you need to this is a core issue if you want to have a successful trading strategy. So this is what we'll be looking at throughout this talk, and this is obviously tightly linked to what's called liquidity. So what is liquidity on Ethereum spot markets? The first metric we'll look at is the market depth. So market depth gives you an idea of the volume committed at a given time on an exchange. And more precisely, here we'll be looking at the 2% market depth. So the 2% market depth is the total amount of ETH, or that you can express also in the quote asset, namely dollar or tether or euro, plus or minus 2% of the mid price. So basically, if I have $1 million on the bid side at plus or minus 2% around the mid price, that means at any given time, I know I can buy instantaneously this amount. And so on the left-hand side, you see this for Bitfinex. So you can see that on Bitfinex, there is lower liquidity for Tether than there is for Ethereum and Euro, for USD and Euro. And you can see that actually the Euro pair and the USD pair are actually quite close on Bitfinex. And similarly, on Coinbase, you can see that well, actually, there is a big difference. On Coinbase, where there's a lot more liquidity on US dollar. And now so that's just to show you how these work on specific exchanges, but now if we want to have a look by pair, this is what you'll get. So on the left-hand side, you can see that there has been very large increases in market depth on Bitfinex recently, in the past few weeks. And overall, you see that it's quite volatile. This is obviously a daily average. So if you look at more granular data, you'll see even more volatility. And you can see that, in general, market depth has been increasing. So there is more and more volume present on this order book around the mid price. OK, and so next. So as we said, if you place a 10K order or a 50K order, you will have to go further away from the mid price. How does this change? How much more slippage will you have to pay in order to execute this order? So this is what those two plots show. So with the dashed line represents what you'd have to pay for a 10K order, and the continuous line is for a 50K order, so 5 times the amount. And what you can see here is basically there is some increase, and on Bitfinex, same as previously, so it's quite similar for Euro and USD. It's much higher slippage if you go to Tether. So you might want to have a look at other exchanges, for example, for Tether. But overall, it's quite impressive how much the slippage has been decreasing on the Tether pair on Bitfinex and also on the Euro pair on Coinbase over the past year. So this means that there's more and more liquidity on those exchanges for those instruments. And finally, for the stablecoin. So on Tether, you can see that on Wobi, there was a lot of liquidity already at the beginning of the year, whereas on Binance, it's been improving at a very important rate. And so finally, if we look at, again, prepare on different exchanges, what you'll notice is Kraken recently added a Ethereum Tether pair. And this is the adoption of this pair on the exchange, where more and more people are willing to trade on this pair. And so you see the slippage going down as people have put more and more volume and the depth increases. And similarly, you can see that there's a general trend, especially on Tether, with slippage improving over time, so making markets more efficient. So next, I'd like to get into the arbitrage question. First observation is, long gone are the days when you could look at the exchange prices and manually go to other exchanges and try and arbitrage out the price. Already a couple of years ago, it was difficult, and sometimes it was difficult to get out of some trades. But now it's just it's not feasible anymore. So for this, we try to get a case which is a bit demanding. So not just same pairs, but different pairs, and looking at stablecoins versus fiat. So we look at US dollar, an Ethereum US dollar pair on Bitfinex, and on a different exchange, what's going on with Ethereum Tether. And what you'll see is this also shows more and more traders where their trading process is, OK, I move everything to crypto and see one Tether as $1. And what you can see on this plot is right in the middle. That is the correlation diagram between the minute returns on the minute price differences on Ethereum dollar and Ethereum Tether on those two exchanges. And so what you can see is that as you might expect, when the price moves on Bitfinex on Ethereum dollar, it also moves in a very similar fashion on the other pair. And now what happens if you shift those price changes by 1 minute? So on the right, you look 1 minute later. On the left, you look 1 minute before. And what you see is the correlation vanishes. And that shows you that price changes are incorporated into the very efficiently in the markets. And in less than a minute, it's already been reflected. And just one little remark on why we look at price differences and not returns. That's due to the microstructure of the markets, where when you go to very small timescales, returns are not as relevant as absolute price differences. Finally, let's try and see, OK, well, let's see in this room, when do you, if you buy or sell, when do you buy or sell? Do you do this in the morning before going to work, at night when you can't sleep, when Donald Trump tweets on Twitter, over the weekend? So that's what we'll try to have a look at. So over the past year, on average, how much was traded on each day of the week, each hour of the day? So let's start with the day of the week, and just simple volume. So how much in total was exchanged on the day? The first thing you can notice is the volumes on stablecoins are impressive, and they're much higher than what you get on fiat. So those plots will show the total volume trade converted into the quote pair, just because it's easier to grasp intuitively. And across all the exchanges named on the title of the plot. And so in general, the volumes are much higher on USDT than they're on Euro or USD. Obviously, volumes are lower on the Euro pair. And most noticeably, there is usually a little dip over the weekend, so there is less volume being traded on weekend. And that's even more noticeable for fiat pairs than it is for Tether. So next, let's just go, so from on the weekday, now we go to the hour of the day. So every day, what's going on? So there isn't really a clear pattern that emerges. You could change, so we look at the whole year. You could look at different months and then try and see if there is anything statistically significant that emerges out of this. One observation is, if you look at Ether Euro, there is a dip over nighttime, which might indicate that there's a little less trading activity overnight. There are also two peaks that are quite correlated on both plots. So if you look at Ethereum Euro or USD, there is a peak around 4 p.m. UTC and another one at midnight. For the peak at midnight, you could think some people have some algorithms that are rebalancing at a particular time. But again, nothing too sure about this. One would have to look a bit deeper. So that's about the volume. Now, still thinking about liquidity, let's have a look at the slippage, which is somewhat linked to it. And again, on the most liquid pairs, on the biggest exchanges, there isn't much time dependence. So whatever the hour of the day, you'll get, on average, about the same slippage. Apart here on Coinbase, you can see there is a little more slippage during nighttime in the EU. Which might indicate, again, that there's a bit less the market liquidity over those timeframes, although you would expect that to be mostly done by market makers with completely automated bots. So not necessarily too sure of where that comes from. And finally, over the week. So what's interesting is we said there was lower volume on the weekends. And that translates in lower liquidity and sometimes in higher slippage. That's not the case on big exchanges because you have a lot of automated bots which are in market makers which are here to provide this liquidity and compensate. And let's say, and also for Gemini, on the Ethereum USD pair, that goes with an increase in the spread over the weekend. And before we wrap it up and open the floor for questions, well, I'd like to thank all the organizers of the ETHCC event and let you know that we are going to be, all this data will be available online through on the presentation, and hopefully we'll have soon some fact sheets that will be delving deeper in this sort of data to try and give an idea of what is going on the markets and how traders are behaving to adapt. Thank you very much.
Someone want to ask a question? We have a bit of time.
Thank you for this very interesting presentation. Just because it's fun to speculate, what do you think would be the reason there is a surge of trading at 4 p.m.?
So the first thing I would look at is how did there might have been like some big moves occurring around that time at particular times. So the first thing I'd look at is, okay, was this the same during Q1, Q2, Q4? Is this consistent across that? The other thing is, it's always unclear about the interactions you could get between Asian markets, US, European markets. So trying to have a look at what time it is in those countries. But the other thing which is a bit tricky in the crypto markets is you don't have the same structure as you have in traditional finance, where traders on the East Coast, on the West Coast, they start at 5 a.m. To match the East Coast time, so the hours are much more framed. On crypto markets, I mean, if you're a trader and you want to wake up at 10 a.m., you can just start trading at 10 a.m. So there is not this big difference. And obviously, it's 24-hour markets. So you don't have the statistical anomaly that you get in traditional markets where at the opening and at the closing you have, especially at the close, you have more volume going on. And potentially the 4 p.m. is related to some sort of soft closing time on more European markets.
Yeah, thank you for your presentation. It's really interesting. I have a question about different type of analysis. You know, like on regular financial markets, there was this market crash of 2008 where people were producing all of this complex, you know, securities, and they depended on each other, on the algorithms. And what ended up happening is that algorithms, no one knows how they run. So at some point, they created like short squeezes or stocks going up and down and things. So it seems like we also like creating these complex algorithms now, more and more complex. So the question I have is, do you see on the markets this kind of erratic behavior where you have the singularities or things jumping due to algorithms? And can one use data just to identify the systemic risks that people may be putting in some kind of catastrophic scenarios where the market just can melt down due to this algorithm, like fighting each other or some other things?
So I think there's a lot to unpack in this question, but I feel some of it is around more very high frequency, low latency trading and, you know, all the flash boys thing and how those impact the markets. Let me just say this, on crypto markets, there isn't as, it's not, I mean, the high frequency is nowhere close to what it is on traditional markets. As to how the microstructure impacts the broader markets, it's always tough to say. There's a lot of research that's been going on the, you know, fractal behaviors, self-similarities across different scales. That's a tough one I won't engage on. Back to the crisis, the 2008 crisis. There's also, a lot has been blamed about mathematical models and how having too much consensus on the way to price those instruments could lead to crashes because people were underestimating the risks. And a big component of that is, okay, how do you price things? But in crypto, I mean, for derivatives, yeah, you can use the traditional relationships, which are more due to the nature of the instrument. On crypto markets, traders have still been struggling to find fundamentals, really. So when a lot of it is speculative, you have a lot of shocks going on in the system, and it's actually quite correlated. A lot of it is correlated to Bitcoin, and that goes into what you said about the market. So if you define there's systemic risk. If you define the market as some average of Bitcoin, a lot of betas are close to 1.